Hey everybody, Real Estate Ninja here. We're going to talk today about Japan and their Forex market. Why? The yen has been falling for quite some time, and Japan sent a shot across the bow to the US dollar, and it's going to affect bonds one day, and it will affect mortgage rates, which will in turn really shape our country's real estate market differently than it's going on right now. Why? All right, a little over a year ago, Japan warned that if their yen kept falling to the dollar, they may find themselves becoming sellers, having to sell their holdings of US treasuries, their bonds, all right? When we have a large amount of bonds being sold by an entity, anyone, a country, a hedge fund, whenever there's more sellers of bonds, rates go up, all right? It's a big deal because Japan holds a ton of our treasuries, a lot. And they have to, before all else, make sure that their currency is stable or it's not completely falling off a cliff. Well, just recently, the Bank of Japan made some changes in their interest rate market, and now they're finding themselves in a crashing yen. Okay, I'm going to read this story, but in the back of your mind, it's not going to talk about what I just told you, but you can put the two together. And this is why you want to watch this as a real estate investor. Japan's top Forex official threatens appropriate action against short speculators as yen craters after rate hike. This story is out of Zero Hedge. A quick glimpse at the Japanese yen's price action against since the BOJ's decision to hike rates for the first time in 17 years one could be forgiven for being confused as a hawkish move and has prompted aggressive dovish weakening of the currency. However, as a reminder, this was one of the most dovish rate hikes we've ever seen, with endless promises of support if the crap hits the fan and continued JGB buying. All right, it says, even more notably, the risk of intervention by Japanese officials in the spot market could cap expectations for any further weakness. A quote here saying, the current weakening of the yen is not in line with fundamentals and is clearly driven by speculation. This comes from the Vice Finance Minister for International Affairs, Masato Kada, told reporters on Monday. He said, we will take appropriate actions against excessive fluctuations without ruling out any options. We are always prepared, Kanda said when asked about a possible direct intervention in the currency market. All right, so right now the yen is falling off of a cliff, right? It's interesting, 17 years without a rate hike, and they just do this small, tiny rate hike, and traders in the market are going, this can't be sustained. This isn't good. Think about it like when we saw the Federal Reserve start raising rates because they wanted to combat inflation. Well, in the beginning of an inflation combat situation, when a central bank is raising rates, it actually makes inflation worse because borrowing costs get more expensive. So companies just pass down in the beginning phases of this, the added cost of doing business down to the consumer. So it squeezes the consumer. All right. It takes a while for those rates, and they have to be high enough to actually do something to actually have some kind of positive effect on inflation, right? But in the beginning, it throws it off. And traders know this. And that's why when the Fed did walk in and start raising rates, we saw that here, right? Our dollar sold off a little bit. Well, it's selling off a little bit more than a little bit in Japan. So why does this matter? Well, it's because if Japan has to intervene, they've got a couple different tools in their toolbox. You know, they've got monetary stimulus where they can print more money, but that weakens the yen even more. But then they have assets, and that's where we come in. They own a lot of our treasuries, a lot of our bonds. They have been a massive supporter of our bond market, and it's afforded us as Americans the ability to just export inflation, right? Well, if they start selling their treasuries to take that money to support, and because they would be selling our treasuries and then buying yen, taking it off the market, right? Supporting it, hopefully finding a bottom and bringing it higher in value. That is going to cause massive turmoil, especially, it's one thing if they do it slowly sell it quietly. But once it hits the media and channels like this, and I start going, hey, they're selling, then what happens is bond traders get spooked, or sellers of bonds, and they start, because people are like, I'm not buying bonds. We've got a country, one of our largest holders of bonds, selling being net sellers. This is scary stuff. You know, we've already went through the cycles of China selling treasuries, Russia selling treasuries, but to see Japan, that's a whole new level of crazy town when it comes to the bond market. So when our rates go up, what does that do to mortgage rates? It causes them to rise as well. Well, we're already seeing our nation in a lot of distress because people cannot afford to buy a home because not only the cost of the home, it's the interest rate that's really killing them. That monthly mortgage rate. On top of that, you've got a lot of people that got into mortgages in the last couple of years that are totally handcuffed and they can't refi at a lower rate. So if it goes even higher, then we're going to be in a lot of trouble. So you see how these are totally correlated. Now, it says, Canada's warnings on the currency, again, we're talking about the Japanese currency, were the first since February. He says, we have seen large fluctuation of 4% in just 2 weeks in the dollar yen, a move that isn't reflecting fundamentals, and I find this unusual. It's always the speculators that get the blame. Bloomberg reports that hedge funds ramped up bearish yen wagers in the week stretching through the BOJ, or Bank of Japan's, March meeting. Leveraged speculators in the currency market increased their holdings of contracts tied to bets the yen will fall to 80,805, approaching the 6-year high of 83,562 reached last month, according to data through March 19th. Says the irony here, of course, is that quietly behind the scenes, Japanese officials wouldn't mind a weaker yen to juice the economy. And why is that? Is because if they have a weaker yen, then their exports become more favorable for other countries. They go, hey, if our currency is strengthening versus the yen, right, like America, we can buy things from Japan cheaper, and that would help bolster their business, their economy. So behind the scenes, they really want that. But they can't also be seen as weak when it comes to monetary policy or their entire economy collapses. So they have this sort of catch-22, right? And that's where we find ourselves in America. And most people don't even comprehend or contemplate another country's currency and how it could affect us because we're America. We're number one. Well, we're only number one because we've been selling our treasuries around the world, and countries have been buying them up, gobbling them up because of the perceived strength of the currency, our dollar. Well, that's no longer anymore. The world's walking away from our dollar more and more in trade settlement. As a matter of fact, in the last 6 months, we've had multiple days where nobody showed up to our government bond auctions. This is a bad thing. This is why the Federal Reserve, Jerome Powell, said in September that we don't even have to really raise rates anymore. The bond market's doing it for us because traders are going, I'm not buying any more bonds. Are you kidding me? This is nutball. I'm not going to give you my money for this much interest. I want more. And it's causing the government and companies alike to keep raising the rates on these bonds, whether they be 2-year, 5-year, 10-year, any of that. I hope you got something out of this. Get ready for higher rates because they're coming. The Real Estate Ninja is out.